Three, two, one, ready? All right. Hey, good morning, everybody. Thanks for joining us today. I got a special guest here with us today, Riley Hayes with Root Mortgage. I wanted to get Riley involved in this just to get a mortgage professional's inputs and insights into what we're seeing in the mortgage world and real estate. And Riley is also somebody who puts out a weekly, I call it an economic digest email, if you will, that encapsulates a lot of moving pieces, both nationally, at the state level, and really kind of trying to break down headlines that we see in the media and what does it really mean. So I wanted him to join us today and just let's get a fresh perspective so you guys don't just hear me talking all the time on Monday mornings. So with that, Riley, I'm going to turn the floor over to you if you want to do kind of a quick introduction and let us know what's happening in the mortgage world.
Yeah, absolutely. Thanks, Jeff. Appreciate the invite to join you here and chat to your world. I work with Root Mortgage, been in the industry for a long time, was in the industry prior to the economic collapse, saw that whole thing unfold from behind the curtains. Got out of the business for a while, jumped back in, wanted to be part of this industry again because it is a wonderful industry to be part of. But jumped back in and didn't want to be a mortgage advisor at all. Just from what I saw in the economic collapse, a lot of the filth and the greed that was in this industry, it just wasn't something that I wanted to do. So I talked to a good buddy of mine, Scott Kirkland, and just said, hey, man, I want to get back in the industry. I either want to be a realtor or I want to be a title officer. And we kind of talked about things, and he was getting ready to create this company, Root Mortgage. And we just talked for a couple hours, and it just everything that I needed out of a career and what I wanted out of an industry was what he was trying to create with Root Mortgage. So we built Root Mortgage based on education, just providing our clients with as much objective information so they can make the best decision for themselves, and just being completely transparent. We kind of pull back the curtain and show you how everything works in this industry. The more you know, the better educated you are, the better decision that you're going to make for yourself. So I do geek out in this business, as you've seen in my updates. I do love the numbers. I love problem solving. While there is no crystal ball at all in this industry, you can generally get a good idea of what direction rates are going to go, the economy is going to go. We are in a global economy, so things that happen in the entire world do affect us here and does affect our housing market here. So I started doing the update during this whole COVID world that you've been getting, just to kind of give more education out there for industry partners. I do one for clients as well. It's not as detail oriented or numbers driven, but just kind of give you some good information on what's happening in this new COVID world, because we are in a new COVID world. Everything has been turned upside down. We're finding just, a lot of people, I see a lot of similarities to what happened in 2007 and 2008, where people are just kind of questioning, hey, what is the next step of my life? What's the next phase of my life? Do I really want to be working this job? Is it providing me what I need? I think being locked in with our families for months and months now. Does our home necessarily work for our new COVID lifestyle? I really do need an office space. So I'm sure you're seeing a lot of that.
Yep.
Kind of, hey, I need a home gym now because my gym's closed down. Yeah. I'm trying to find home exercise equipment. Every place is sold out, man. There's no gym equipment. So, and I think what we're going to see too is just everyone's just going to kind of recreate or redefine their own job and their positions. Companies have seen a lot of success of people working from home. So how is that going to play in the future when we start to reopen like we are now? So the mortgage world was kind of flipped on its head in March when all of this kind of went down. Mortgage rates were, kind of almost hit the bottom of where the lowest they'd ever been in the summer of 2019. And then we steadily climbed upwards. And then January was just kind of, all right, we're going down. And then, February and March hit, and the 10-year Treasury note and mortgage-backed security market and every market, stock market, everything, everybody was trying to sell. sell everything. Businesses were trying to raise as much cash as they could. Banking institutions, lending institutions, servicers were trying to raise as much cash as they could. We were having a real liquidity crunch. People just didn't have the cash they needed on hand. And so when you go back to early March and you look at all the equity market and precious metals, usually safe havens where the stock market starts to crash, people pull their money out and they invest in bonds because they're incredibly safe, or they invest in precious metals. Nobody was buying anything. And that really sent, in the back side of the mortgage world, that really sent things into quite a downspin. Why did that happen? Well, nobody was buying mortgage-backed securities, which is basically our mortgage has been pooled together, and they can be sold as an investment tool, and people can buy those. And as long as people are making payments, it's generating interest, and people are making money off of that. So nobody was buying anything, and lenders could not accurately gauge how much risk that they were about to take on. Rates should have been a lot lower than they were at that time, but all of a sudden, when nobody was buying anything, mortgage rates just went sky high. We went from 3% to maybe 3.5, 3.75. Nobody could accurately gauge, if I'm going to write a loan and lend it, I don't know how much risk I'm going to take on in the future, because this person might not have a job anymore. Yep. And if they don't have a job anymore, they don't make their payments to me anymore. The one thing to remember is, when you write your mortgage payment every single month to your loan servicer, that loan servicer does not own your mortgage. They only own the servicing rights to be able to send you the statement every month. And you write your check out to them. They take care of the principal and interest. And then they take care of your escrow account that handles your taxes and insurance for you. And there's a good profit for loan servicers to make in that role. The one thing that most people don't know is, part of those servicing rights, those agreements state, Jeff, if you don't make your mortgage payment, I still have to turn around to the investment pool of where your mortgage is placed, and I still have to make that principal and interest payment, even if you don't make that payment that month. So March happens, unemployment people just start getting laid off. Servicers are like, here we go. We're going to have a lot of people not making their mortgage payments. And then the government came out and said, hey, forbearance, everybody. If you have a COVID-related issue, you can claim forbearance, and you don't have to make your mortgage payments. They didn't really think what would happen in the secondary servicing market in the mortgage world. So if you have a COVID-related issue, and you don't have income coming in, that's what forbearance was designed for.
Yep.
But all of a sudden, there was no qualifications for it. You could simply call your servicer and say, I'm not making my payments.
Yep.
And the servicers themselves didn't know how they were going to handle that. Okay, do we not let you make payments for 6 months, and then on month 7 you have to pay all 7 months up front? Are we going to tack it on to the loan balance? Nobody really knew what was happening. So we had this massive influx of people now claiming forbearance. So if you were a servicer and your job is to collect monthly payments and then pay that to somebody else, now you don't have payments coming in, and you have a lot of money going out every month, millions and millions of dollars with some servicers.
Yep.
And we saw some servicers go bankrupt because of it and shut their door. Another thing that helped create as well was that's a lot of risk for a servicer to take on. So if I'm an investor and a lender and I'm writing mortgages, I'm not going to want to write a mortgage to somebody who may have a stronger, who may have a higher risk of losing their job, who may have a higher risk of just saying, forget about it, I'm not making my payments. So what we saw in March and April was lenders just tightening down. You know what? If you got a 660 credit score or below, I'm not lending you money. Or if I do, the rates are going to be significantly higher. And that's what we saw. If you weren't a good credit score borrower, high FICO, low debt to income. If you were, we're just doing a conventional loan, that's where people were wanting to lend mortgages to.
So we even saw on our side, some of our clients who good income, really good credit, were being talked to about rates, let's just say at 3.25%, at the time, and literally blink and later that day they're like, hey, it's been revised, it's 4.25, 4.5. It's like in one day, it's like, what just happened? And then within a few days, they just plummeted back down again. But at that point, people have made decisions, and it was a weird time for sure.
Yeah, absolutely. There was no rhyme or reason to it. Yeah. And if you go and look at a 10-year Treasury note, if you go look at the 10-year Treasury note right around, just do a year to date, go on a CNBC 10-year Treasury note and look at the performance of it. It trades every day in these little candlesticks, right? These little tiny movements. And then, you see it trickling down, which means, mortgage rates are likely going down. And then in March, you just see these massive swings every day. And that's when you saw the stock market up 1,000, down 2,000, up 800, down to 2,000. That just caused so much volatility in the marketplace that lenders didn't know where to price their rates, because they didn't know if they were going to be profitable on that or not. So pricing real low in the morning. We filled our belly up with enough mortgages that we want or feel comfortable writing. And so what lenders do when their pipelines are full, to help mitigate more incoming files, they raise interest rates.
Yep.
It's like, okay, I'll do it, but you're going to pay a higher interest rate. That's just how the mortgage world works, especially in very unstable times as well. So a lot of that was going on March. Products were being cut right and left. If you weren't a great borrower, you were going to have to pay a higher interest rate and a lot of points and fees sometimes for those rates. Some investors said, it started out, we're not lending 660 and below. Then it went to 680. Then it was 720 and below. Some folks were saying FHA, not doing FHA loans anymore, not doing USDA loans. VA even got caught up in that a little bit too, which, a VA loan is by far the best mortgage that our veterans can take advantage of, the best loan out there. But even those were suffering a little bit. Jumbo products, which in the Portland market is anything financed $510,400 and up. What we saw at that point, that is where a bank is truly reaching into their bank vault and they're lending you money to go buy the house. When you look at a conventional loan, an FHA loan, a USDA loan, or even a VA loan, all of that money is coming from the federal government. But a jumbo loan is where an investor is truly lending their money out for you to buy that house. So they get to write the rules. They get to say, and typically jumbo loans have higher credit score requirements, more reserves. You got to have more money in the bank. What we saw was, the big players in the jumbo world, which are the big banks, Chase, Wells, US Bank, Bank of America, they started pulling their product offerings from the correspondent world or the broker world. So I'm set up as a correspondent lender, a mortgage banker brokers. We can fund loans on our own lines and then sell them to Fannie, Freddie, and other investors out there. And we can also broker around, which means basically I'm not tied to one institution. I have the ability to shop around for my clients and look at who's offering what. And I really saw the power of that in March when some of my investors pulled out of some products. They were still really competitive on others, but some of our other investors, were better in the cash out refinance world than others. So it allows us to really shop around. We also, can lend the products of the jumbo world, the Chases and the Wells and US Bank. And we have access to those products. What they did was they pulled those products from the broker and correspondent world and basically said, if you want to use a jumbo loan, Wells Fargo was first to do this, you have to come into a bank, a Wells Fargo bank, and you have to talk to one of our loan officers in the bank. Wells Fargo took it a step further and said, if you want to do a jumbo loan, a refinance with us, you not only have to come into our bank, but you have to be one of our banking members, and you have to have at least $250,000 in the bank with us. I don't know if they're still making that a requirement or not, but that's how they wanted to control as much risk. The whole thing is risk, right? We want to mitigate as much risk as possible, so we're going to take it in-house. So for a while there, jumbo products were really kind of gone. They're starting to come back out as we kind of continue on through this. We're trying to figure out what the risks are. More of those products are coming back. FHA, VA, all those products are back. Rates are fantastic with them. So that's really kind of what has happened overall in the industry. We're still taking our cues from coronavirus. It is controlling everything.
Sure.
So we're continuing to watch these reopenings that are happening and how the reopenings are going to go ahead and impact our state's going to shut down again. And I think one thing that we saw here, and we're a little bit insulated in the Portland market. We're still the least expensive city on the West Coast to live. We still have a large influx of people from California, people from Washington coming down. As you know, we don't have enough homes for the people that want to buy them here, which has stabilized our prices in this market. Our home values continue to rise during this market. When I look at what happened in 2007 and 8 and what is happening now, I see some similarities. We saw a lot of those pullbacks of products. HELOCs, home equity lines of credit, became unavailable. Cash out refinances were non-existent. That happened to us. We're starting to see those come back now. But what's different is 2007, 2008 was led by the problems in the house market. And that's not happening now. We're just getting caught up into this. So, we could talk about this later, but I still see a very robust housing market here for us. It's still a tried and true way to build wealth in America.
Yep.
If you look at the statistics, the average homeowner has a net worth about 40% higher than somebody who rents.
Yep.
So it's still a great way to really build wealth in America these days.
Yeah, and this is something that I talk about pretty regularly. I mean, people are probably sick of me talking about it on here on Monday. Is the inventory level of Portland in general, and that it was constrained to an extent leading up to the 07-08 meltdown. Well, then you had a 8 to 10 year deficit where people just weren't building. Right, you had builders who exited the business, went bankrupt, couldn't get the land, whatever. They froze in place for a long time. And now they're back trying to start rebuilding kind of back to capacity or back to more, I guess, pre-Great Recession levels. But you've got that 8 to 10 year gap of undersupply. Well, the population continued to grow. Net migration continued coming this way.
Yeah.
So I kind of make the argument of, even if all things are equal, if you've got, say, an 8 to 10 year undersupply, you need an 8 to 10 year oversupply of the equal magnitude just to offset that, except that you still have incremental demand growing and the census and millennials now buying. And so are you looking now at more like instead of a 10 years, at a 15 year, 20 year? You throw in the urban growth boundary, you can't even get the dirt anywhere.
Right.
And I've become the biggest cheerleader of owning real estate in the Portland metro area because I don't see any relief in sight anywhere other than you get maybe some of these little blips. We see it on the charts where you see the growth in values. It's up, this down, it's a tick, and this back up. And if you can buy on one of those little bounces, great. But it's a rounding error at the end of the day within a couple of years. And So I'm with you. I think it's a great time. Talk to me a little bit about if people are looking to do purchases, and if it matters if you send on refis, but on the purchase world, there's always the big misconceptions of I need 20% down, and I know some programs will call for that, some scenarios. And I know it all depends on income, credit, and so forth. But what are you seeing out there at different programs or different opportunities for people at a variety of down payment levels? What do you see?
Yeah, absolutely. Down payment is usually the number one item where that could be prohibitive for people to go out and buy houses. Yeah. Not so much credit. Hey, credit's easy to repair if you've got issues, late payments and stuff in the past. It's pretty easy to get credit scores risen in a quick period of time, but it's hard to save that cash for most folks if they just haven't done it or if they're just starting out. So there are a variety of down payment options. You don't need the 20% down. Most folks, I still talk to people who still think you have to have 20% down to buy a house, and it's just not the case. Conventional loans will allow you to put 3% down. FHA loans will allow you to put 3.5% down. USDA loans, if you're buying outside of the Portland metro area and you fall within their income limits, you don't have to have any money to put down. Same thing with the VA, 100% financing options out there. There still are some down payment assistance programs. Typically those, again, kind of go away during these hard economic times. But there still are some programs out there. I believe it's the Portland Housing Bureau is really kind of the one that has a list of those programs that are available, yep, depending on what county you're buying into. Gresham has one that will give you basically a second mortgage for your down payment if you buy out in the Gresham area. Clackamas County has one as well. Typically, those programs, I get people all the time asking me about those. Those are generally, they have income limits on them. Mm-hmm. So a lot of those you can't make more than, say, $55,000 or $60,000 a year to qualify for those programs. A lot of them think, hey, it's free money. A lot of the down payment assistant programs, there's really nothing free in America these days, especially money. So they usually come with higher closing costs, higher rates. There is a product out there. I don't know if it's available anymore. In my opinion, it was pretty bad. It was basically an equity share. We'll give you the money to get into the house, but when you sell it, I get a portion of your equity. I would never recommend anyone get into anything like that.
It's the whole reason to
buy. Right. But there are, if you save up some money, hey, great. If you're a first-time home buyer out there and mom and dad want to help you, or an uncle or a family member wants to help you, gift options are great as well, and you can use those to help get into the property too. So there's a lot of different ways that we can sit down and figure out, okay, where are you at right now? What's your plan? And I like doing that with clients anyway, even if it's like, Riley, I don't think I'm going to buy for another year or so. So let's connect in 8 months. And it's like, no, let's connect now. Let's put a plan in place now. You need X amount. How are we going to get there? And sit down. We just create the plan step by step. This is what you need to do. Yeah. But yeah, I would say down payment's kind of the number one prohibitive factor for people buying homes.
So here's a couple questions I get regularly, and you sort of hit on this earlier about credit scores have taken a hit and rebuilding those are pretty easy. Questions I get fairly often from people in that camp are, what are the easiest ways for me to find out what is my credit score? And then kind of what's that whole repair process look like? And their concern is, because I tell them, like, what I hear is like Credit Karma apps and things like this will help you check. What I honestly don't know is, does that create a hit on every time you check your own credit score, is that counting against your credit score? Or are those sort of freebies for you? And how often can you check, and when and where? And then the repair process, what's your recommendation of, is it going through a service? Is it just talking with somebody like yourself? Or what's the best way there?
Yeah, great questions. Deal with this all the time, every day. When you check your credit score on like a Credit Karma, Mint, one of these websites, no, it doesn't ding your credit. Okay. For folks that don't have access to those or don't want to pay, I believe it's a monthly subscription because it helps you monitor your credit. For those that don't want, I would say, hey, you know what? Your credit card, usually log into the website if you have a credit card and check your credit card. They'll give you a sneak peek at one of your credit scores. The important thing to note is each of the credit bureaus, Equifax, Experian, and TransUnion, they're the for-profit credit bureaus. They really don't care about you and I. Their sole purpose is to collect data from all of your creditors. And then what they own is the scoring algorithms, basically a computer algorithm that analyzes the width, the depth, and everything that's happened in your credit history, and it generates a score. Yep. What most people don't know is they own about 46 of those different algorithms. So it really matters on what you're applying credit for. And that'll analyze your history a little bit differently and spit out a score. So, for example, if you go to apply for a car loan, it's going to use a different scoring model that's going to come up with a different score. If you check your score on your credit card site, it's giving you, and Credit Karma, Mint, they're going to give you your retail score of what your score would pop up if you were applying for a credit card. Mortgages use completely different scoring models. So I've had people come in and say, hey, Riley, my credit's great. I have a 900 credit score. And it's like, that's awesome. But the mortgage scoring models don't go that high.
Yeah.
So, typically we pull a score from each of the bureaus. We throw out the high score. We throw out the middle score, low score, and we use the middle score for qualifying for finance. So checking those, it won't impact your score.
Okay.
The how to improve your score. So if you look at your scores and you're like, man, I've had some missed payments in the past, or my score is at 680 or 660 and I don't know why. About 35%, I always tell people, your use of credit cards is going to be the quickest way to positively impact negatively or positively your overall score. So about 35% of the weight of your credit score is based on your payment history. So make your payments on time, even if it's the minimum monthly payment. Do your best not to miss a payment.
Yep.
Once you miss a payment, it's going to stay on your report for about 7.5 years. Another 30% of your score is going to be based on what we call your proportion of balance to limit. And this is usually where I can get people's scores up as quick as possible. So if you're ever going to go for financing, take a look at your scores, okay? Also take a look at where your credit card balances are at. The closer you get to maxing out that card, the farther your score is going to go down. Yep. The golden rule is usually 20% of your balance to your limit. That's kind of the sweet spot, 20% or less. So if you know you're going to go for financing at some point, take a look at where your cards are at. If you have some low balances, pay those down if you can, and that will help generate a higher score. The rest of it, 15%, I believe, is credit mix. You have a car loan, a student loan, mortgage. Another 10% is it's escaping the top of my head, but they're not as important as that 35% for payment history and 30% for balance to limit. So that's usually where you can attack and get your score up the highest. And I would never, ever, ever recommend anyone go out there for credit counseling or pay somebody to do it. Yeah. Your mortgage advisor should be geeky enough on credit to give you some direction and some insight on what may make sense. It's usually a waste of time, because what credit companies that say, hey, we're going to fix your credit, basically what they'll do is they'll inundate your creditors with these letters saying, hey, stop. And it causes them to freeze reporting for a little bit. Yep. And then they come back and say, look, we got your score up. And you're like, great, here's $1,000. Thanks for doing that. And then as soon as they stop sending those letters, score goes back down.
Yeah, that's no good. So if there's these different scoring algorithms then, and the best one to make the determination for my availability to get mortgage financing is talking with someone like yourself. So going now to Mint or Credit Karma or whatever, it's not going to be the right answer. It's not going to give me the right score. And I don't know to what extent it's so different. So then is the best approach then to come talk to someone like you about, hey, what's my mortgage credit score, if you will? And then when you pull it, does that then count against me?
Yes. So, you can get a good idea of what your scores are based on the retail score, right? If it's in the 700s and 800s, you're pretty darn good. Yeah. If you go to Credit Karma and it's like, hey, you have a 500 credit score, then we know that the mortgage score is probably not going to be that great either. So it'll kind of give you an idea of where you're at. But yeah, when you come to your mortgage advisor and you sit down, you start making a plan, and hey, I want to get pre-approved, whether I'm going to go out and start looking this weekend or if it's 6 months or a year from now. Yeah, you will have a hard pull because we have to pre-approve you. I mean, I need credit to make sure that you're pre-approved and you'd be able to get a loan. That acts as a hard pull, which is a hard inquiry that does deduct a few points. Not a big deal every now and then.
Yeah.
When you continually, apply for credit cards in the mail, great. Hey, 0 interest for the first year. And I've had clients come in and do this, and they're like, hey, I apply for that 0 interest, and I basically put my balances, I open a new card every 6 months or so and then close it out and give the balance transfer. And, they play that game. You're going to absolutely impact your credit score. The more pulls you have in a period of time, we look at 12 months, we look at 4-month windows. The more pulls you have, the more it is going to impact your score. Getting it pulled every now and then, not a big deal. When we pull your credit for a mortgage, that credit report is good for 4 months. Yeah. So
Good to know. Good to know.
Yeah.
So here's the big question on everybody's mind, and we use this as sort of a wrap up. We know rates are good, right?
Yeah.
One day to the next, they're a little bit worse or they're a little bit better. And I know I'm not going to ask you for rate quotes. I know it's so dependent on credit and income and program and all that kind of fun stuff. But I say it's fair to say that I've seen some in the high twos, which is crazy to me, but fantastic. So if we just want to make the argument that rates are at historic lows, I believe June was the lowest monthly average on recorded history. So talking in global terms like that, Riley, for the balance of this year, next year, what are rates going to do? What's coming? What do people need to be thinking about?
Absolutely.
We have time.
Yeah, absolutely. I don't have a crystal ball, so I can't predict the future. If I did, I'd be on the beach in Hawaii doing this job. But, I follow economic reports. I follow what's happening globally. We are hurting right now in this economy. No question about it. You can't lay off this many people. You can't have this high unemployment rate without lasting effects to the economy. Look at the stock market. You're like, well, stock market doesn't care. Stock market doesn't look in the past. Stock market looks in the future. All it cares about is this economy going to recover? Yeah, it is.
Yeah.
It will at some point. Is that going to be this year? I don't think so. Is it going to be next year? I don't think so. I think we're going to have a long-term effect of this. I think it's going to be a gradual get back to reality. Watch the reopenings. If the reopenings start happening as they are now and cases spike and we have to shut down again, that's going to be problematic too. The one thing to remember is mortgage rates love bad news. They love bad economic news. High unemployment, mortgage rates love it, so they go lower. Bad economic news, we're not manufacturing, we're in a recession, mortgage rates love it, they go lower. So if I look at this year, I don't see us coming out of this economic recession that we're in anytime soon. So I can't, for the life of me, think of one reason why mortgage rates should take off. I think they'll continue to be low. Under 2%, or I'm sorry, under 3%. I don't know, but I really don't think we're gonna see the best credit, profile borrowers seeing rates close to 4%. I think at least through 2021. That's my opinion. I just don't see the economy being strong enough to warrant interest rates climbing higher. I just don't see it. So folks who aren't ready now, who are like, I have to get out there and take advantage of these low rates. To me, these low rates are going to be there for a long time, which means money's cheap to borrow, which means you can buy more house on a mortgage with a lower interest rate than you can with a higher one. And I think that's going to be in place at least through next year.
So I agree, and I think I've shared that same sentiment a few times. So I was curious to get your take on it, just I guess to make sure I'm not way off base when I say those kind of comments. So I agree. I see them staying low for a long time. The flip side of that is they're going to stay low for a long time, meaning it's incredibly cheaper to buy, or at least to finance the purchase of a home, which is going to continue to fuel that demand, and then go back to that constrained inventory of prices. So yes, it's going to stay cheaper and it's going to get more expensive every single year. So, but that's what I tell people when I talk to some of my clients is you're not gambling against rates if you're buying time, or you say I'm going to sit and wait.
Right.
You're not betting the house on the rate. You're betting the house on our property value is going to stay the same, or at what point is that home that you're looking at today, you're going to buy it, say, next year. At what point does that house appreciate in value such that whatever you've saved on your rates, you're just giving it right back again on the price value? And it's where I think Portland becomes kind of a tough market, but it's the reason I love the market at the same time is there's so many moving pieces, and I'm with you. So if anybody wants Riley's newsletter, you put a comment on here, we can get you guys connected. It's a great little weekly snapshot. There are times where, Riley will preface it. And I think you've got the consumer facing version. And then you've got whatever population of us get the other one that basically says, this is a 4-minute read. Just work with me. I think I've seen some. This is a 17-minute read, and it is as nerdy can get. And when I read it word for word, and I love that stuff. But it's good insights to have it if nothing else. So Riley, I definitely appreciate you taking time out of your morning to jump on here and talk mortgage shops. again, if anybody, we work with Riley quite a bit between Jeannie and I, and if anybody is looking for more insights, wants to pick his brain of what about this or what about that, or you're ready to work on pre-qualification, give us a shout. We're happy to make the introductions. And otherwise, Riley, have a great week. Hope you stayed safe over the 4th, and we'll certainly be talking to you soon.
Thank you very much, sir. I appreciate the opportunity to come on here and chat. And make it a great day, man.
Appreciate it, Riley. Thanks, everyone.
All right. Bye-bye.